Hey everyone, welcome back to Corporate Decoder, the place where we decode the real stories behind the corporate world. And today, folks, we're diving into a Form 8K from Plum Acquisition Corp IV. And let me tell you, it's got some interesting tidbits about how they're funding their future plans. So what's happening here is that Plum Acquisition Corp IV, which is basically a company set up to buy other companies, has made a deal with its sponsor to get some money. Think of the sponsor as the main investor or the founders group. They've taken out an unsecured promissory note, which is just a fancy way of saying a loan that isn't backed by any specific assets. This loan can be for as much as $1.5 million. Now, this loan doesn't have any interest attached to it, which is pretty sweet. The main catch is that the whole amount needs to be paid back on the date when Plum Acquisition Corp IV actually buys another company, which they call the business combination. Here's where it gets really interesting though. When they do buy that other company, the sponsor, the one who gave the loan, has the option to turn that loan money into shares of the new combined company. And how do they figure out how many shares they get? Well, they take the loan amount and divide it by $10. So if they loan the full 1.5 million and decide to convert it all to shares, they would get 150,000 shares of the new company based on this $10 conversion price. This is a common strategy for these types of acquisition companies, sometimes called SPAS, to make sure they have enough money to operate before they find a business to merge with, while also aligning the sponsor's interests with the company's success. Now, let's look at what kind of shares we're talking about here. Plum Acquisition Corp IV has units that trade on the Nasdaq Global Market. These units are made up of one Class A ordinary share and half of a redeemable warrant. Then there are the Class A ordinary shares themselves, which are part of these units. And finally, you have the warrants. These warrants, each whole warrant can be used to buy one Class A ordinary share for $11.50. Think of warrants as options to buy stock at a set price in the future. The whole point of this filing and this loan is to keep the company running smoothly until it can complete its main goal, which is to acquire another business. They also check a box here indicating they are an emerging growth company. This means they qualify for certain relaxed reporting requirements and can use extended transition periods for new accounting standards. This is pretty standard for newer companies or those in the process of these acquisition deals. It gives them a bit more breathing room. So what does this all mean? Well, this promissory note is essentially a lifeline. It gives Plum Acquisition Corp IV the financial flexibility it needs to continue its search for a suitable business to acquire without being immediately burdened by interest payments. The fact that the sponsor is willing to provide this funding and even has the option to convert it into equity shows their commitment and belief in the company's ultimate success in finding and completing a business combination. This deal structure helps manage risk for everyone involved. The company gets the capital it needs now, and the sponsor potentially benefits from an increased stake in a successful future entity. It's important to remember that this loan is unsecured. That means if something goes very wrong and the company can't find a business to merge with or doesn't pay back the loan, the sponsor has fewer immediate protections compared to if the loan were backed by specific assets. However, given that the sponsor is the one providing the funds and likely has significant influence and knowledge about the company's strategy, this type of arrangement is often seen as a sign of confidence. The CEO, Kanishka Roy, has signed off on this report, indicating the company is moving forward with its operational funding strategy. Looking at the broader picture for companies like Plum Acquisition Corp IV, their success hinges entirely on finding the right acquisition target and executing a smooth merger. The trading of their units on the Nasdaq Global Market means they are subject to public scrutiny and market forces. Investors are watching closely to see if they can deploy their capital effectively. This particular filing points to a company actively managing its finances to achieve its core objective. The $1.5 million note is a critical piece of that puzzle, bridging the gap between their formation and their ultimate business combination. It's a strategic move that prioritizes operational runway over immediate debt servicing costs, a common play in the SPAC world. So what's my take on Plum Acquisition Corp IV based on this? Well, this filing shows a company that's being pragmatic and proactive in securing its funding. The interest-free loan from the sponsor is a strong vote of confidence and provides much needed flexibility. However, like all SPACs, the ultimate success or failure will depend entirely on their ability to identify and successfully merge with a valuable operating company. The conversion option for the sponsor incentivizes them to make that happen. The risk, as always, lies in the execution and the market's reception of the eventual business combination. Investors should watch for news on their acquisition targets very closely. Alright, that's our breakdown of Plum Acquisition Corp IB's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.